All right, as far as investment strategies for 2023 is concerned, the latest outlook report from Sankore Global Investment sounds like the 1958 Academy Award nominated film The Bold and the Brave. The investment strategy calls for, titled Taking the Bull by the Horns, and points to opportunities dotted across the global economy amidst geopolitical tensions, elevated inflation, and central bank tightening. Joining us to discuss the report is Efosa Aluyi, who's the head of investments at Sankore Global Investment. Efosa, good to have you physically in the studio.
It's good to be here. Thanks for having me.
Yes, you're very welcome. So look, you've got a robust report here that really goes into a whole lot. I wanted to start with your your growth forecast for the US and the EU. I think 1.5% for the US, 0.5% for the EU. Can you talk us through the triggers or what's informing your forecast there?
So essentially, in response to, decades high inflation that we saw the better part of last year, really, we've seen, very aggressive monetary policy response to try and basically knock inflation off of its perch. And that's the reason we think that growth is going to slow this year. That aggressive monetary policy actually continues into this year. Just last week, the US Fed hiked by 25 basis points and essentially indicated that it will continue to hike until it basically tames, inflation. So on the back of that, we think that growth will certainly slow. And that's why we have that forecast for the US and the EU. If you look at the sort of growth that we've seen in both regions, actually, over the last 2 years, really, we essentially saw a post-COVID bounce in growth, obviously, but that growth is beginning to, come off, and we think that, this aggressive monetary policy situation would continue to provide impetus for the growth to even continue to taper off, really, and that's why we've made, the forecast that we have, for the US and the EU, and not just those economies, really. Yeah. On a global scale, we expect that growth will slow down. I mean, the jury's out as to whether we would have a recession. We don't think there's going to be a recession. The jobs market in the US remains really resilient. The EU has proven a bit more resilient than we thought, particularly the pass-through of energy prices. Nevertheless, the impact of inflation still remains very significant there. The US has made even more strides in trying to bring down inflation. Obviously, the US Fed got off the mark quicker than the ECB, and we're seeing the impact of that. But in all, we think that these factors will certainly, slow growth down, for 2023.
And you've got a portfolio strategy here. I want you to help us out. We return to long-term U.S. allocations, I think, for equities, reducing liquidity, and then you're overweight U.S. fixed income and equities. And then help me with this, eliminate underweights Bitcoin and global real estate. Are you saying that, so moving from an underweight position to a neutral or overweight for Bitcoin and...
So essentially moving from an underweight to a neutral, right? Just to go through it again, we think that, the sort of move that we saw last year, particularly US equities. The S&P was off almost 20%. That's the first, bear market that we've seen in over 10 years, really. And on the back of that, really, we think that valuations have come to a sweet spot. We think that there's really good value, in US equities. However, like we highlight and capture in the theme of this report, it's going to be rocky. There's still going to be, some volatility. Certainly not on the scale or level that we saw last year. There is going to be some volatility, but we think that volatility is going to be a ride up, right? And we think that we're going to see a recovery in risk assets, particularly US equities this year. And on the back of that, really, we've seen very strong positive correlation between US equities and cryptocurrencies, right? And we think that, that's going to also have a thing to play on cryptos this year. And that's the reason we've moved from an underweight to a neutral for cryptocurrencies. Now, for global real estate, the real estate market really has been hot post-COVID. However, we think that it's beginning to come off. If you look at the US, the rate on a 30-year fixed mortgage has pretty much doubled, and that is impacting demand quite, significantly. So we expect to see house prices come off a little bit, not anything, dropping significantly, but we think that, opportunities to get into, that real estate asset will certainly show up this year.
And bonds, I want to talk bonds. You've got a chart where we're looking at bonds having a tough time in 2022 as a result of central bank tightening, raising rates and so on. So so there's the chart right there. What is your outlook for bonds, I guess, for 2020? Because the tightening still continued. The Fed last week, the ECB, the Bank of England, and even in Nigeria, South Africa. So how do you see, what's a bond outlook?
Yeah, so the tightening continues, however, at a much slower clip, right? Last year, we saw 4 consecutive 75 basis point hikes. That was really aggressive. That's the most aggressive clip we've seen, by the US Fed in a generation, really, right? Now, we, however, see that tightening clip is certainly going to slow down. This year already, we've seen a 25 basis points hike. The market before the jobs report last week had basically factored in the fact that we're going to have just one more hike and that'll be it. However, with that job number showing very resilient labor market in the US, we're factoring in another 25 basis points hike. So the rate at which that hike happens is certainly slowing down, and we think that we will get to the peak of the cycle, say sometime in Q3 of this year, and that should see a situation where, bond yields stay at that level. And if, we see, things move in a way that the Fed needs to react, we could see, rates come off towards the end of the year, and that should, bode well for, fixed income, particularly if you are invested at this point.
Okay, very insightful there, very insightful. What about the all-important commodities? What's, I guess, in oil in particular and in the others, how do you see commodities playing out for this year?
Yeah, I mean, if you look at the entire commodities complex for last year, it was essentially a year of two halves, really, right? You had the, commodity price movement just before invasion, and really post-invasion, you had a really strong bounce, in commodity prices. However, after the, Russia-Ukraine situation, we saw, commodity prices really start to come off. You look at soft commodities, you look at gold and all of that, it really started to come off on the back of concerns that, growth was going to slow down later in 2022 and into 2023. And, we saw that really play out. We saw crude oil top about $130 a barrel. Right now, it's just hovering around the $80 mark, So we think that that recovery or correction, if you will, that we saw in the later part of 22 would likely fizzle out just on the back of the fact that you're seeing China reopen abruptly, really. We didn't expect that China was going to reopen. In fact, forecasts were that we'll probably see some kind of phased reopening by the end of Q1 this year. However, because of the social situation that, it erupted, we saw an abrupt reopening late last year. And obviously, that's going to create some demand, for commodities. We don't expect that demand to be strong because, again, if you look at what's been happening, China has been buying really cheap crude oil from Russia, and that is expected to continue. So we don't expect that to put any strong upward rise in the price of commodities. However, it creates a really solid bottom for those prices, So we think that, commodities prices will, get some support this year, but we don't see any strong upside, this year.
Well, what about still on oil and still on commodities? Would the war in Ukraine, was that still expected to support prices in some way as far as getting traders nervous with the implications? I mean, we saw what it did to oil prices last year, right, in February. So do you think that's that factored in somewhere?
It kind of feels like the world has, gotten used to that situation. I feel like we've essentially descended into a war of attrition. Yeah. Except we see some sort of escalation, really, which, really is anybody's guess at this point. I don't think that geopolitical situation has the potential to create, any major shock, if you will, to commodity prices, at least in the near term. We're just going to continue to see, those skirmishes. It really is unclear what the plan is right now, as far as the Kremlin is concerned with the whole Ukraine situation. We, however, continue to see the West continue to support Ukraine, even with heavier artillery as things go on, but that war has essentially descended to a war of attrition as it is, and I don't think that in the near term it has really strong potentials to upend the price of, commodities.
Okay, now commodities are priced in dollars. There's a chart I want to take a look at where, and I like this chart very much. You've overlaid the Fed funds rates with the movements in the dollar index, right? And as you can see here, the US dollar index is up about 8%. What's your outlook for the US dollar this year?
Not as strong as last year, really. I mean, like I highlighted earlier, as the pace of Fed hikes or the monetary policy aggressiveness, if you will, as that starts to come off or taper off, the strength of the dollar would also be impacted. Recall that the U.S. got off the ground quicker than anyone else in terms of tightening, and that was one of the reasons why we saw a really strong move in the dollar last year. However, we also think that the U.S. is probably going to come off that path quicker than everybody else, and that should spell some sort of softening, in the dollar index this year, at least towards the end of the year.
A couple of minutes before we touch a break, what do you make of the argument that, or rather, the position of other countries that are envious of the US dollar being the reserve currency of the world? Do you see any threats? I mean, like we talked a couple of weeks ago with another guest about Brazil and Argentina wanting to have some kind of combined currency for trade. We know how China and Russia feel about the US dollar wanting to. Is there any threat to that for the US dollar being destabilized at any point in time as the reserve currency of the world?
I mean, the truth of the matter is that the hegemony that the US created post-World War II has been very much entrenched. It is really, really strong. A dismantling is going to take quite some time. But within the realm of possibility, that's not impossible. I mean, we're seeing China rise. We're seeing, portions of the global economy actually trade in yuan. But the dollar remains king, really. And if you look out over the next maybe 15, 20 years, I think it is likely to remain that way. But whether something gives or something changes at some points, if you look through history, it is replete with examples of that.
Great stuff. All right, we'll take a quick break. Very, very, very interesting conversation here. We'll have more on your global outlook. We're still speaking with the head of global investments at Sankore. This is, of course, Efosa Aluyi. We'll be right back after the break. Stay tuned. It is the Global Business Report here on Arise News. We're still talking with the head of investments at Sankore Global Investments, Efosa Aluyi, talking about the global outlook, and we left off on the US dollar. Efosa, thanks for sticking around with us. So before we went to break, we're talking about dollar strength and how you see the dollar moving this year. I hope we still have that chart of the Fed funds rate and the US dollar index, where they're both almost moving in tandem. So if we bring things home, Efosa, what does dollar strength mean for cost of living in Nigeria, imports, sending your children to school overseas, medical tourism, just everything? What does it mean for us here?
I don't think it's lost on anyone what that really means, right? Again, the FX situation locally has been the elephant in the room for quite a while now. Something's got to give. It's got to be dealt with one way or another. If not, we would just be continually subject to the vagaries of what goes on with the dollar internationally, and it will continue to stoke significant inflation locally, where purchasing power gets consistently eroded. I mean, if you look at the inflation situation that we've got, a sizable chunk of that is down to the fact that that we have this inflation globally, and we have the dollar strengthening globally. So it obviously has an impact on us locally. So again, from a policy standpoint, this needs to be dealt with. We have to take very bold decisions around what we need to do about FX and fix that. Else, the impact of the debilitating impact of that situation becomes entrenched in the economy, and that's really not good for anyone.
When we look at the NGX, I want to get to stocks now. You've got, if we look at the performance from 2022, so did 20%. NSE 38%. Oil and gas did very well. You've talked about oil, how it performed, tale of two halves last year. Industrials, although we saw insurance and consumer goods struggle. Can you take us through which sectors you like on the NGX for this year, and how you think the NGX is going to perform?
I think if you look at the performance of the NGX last year, it was a reflection of a couple of names that did really well. Make no mistake, that was not a broad-based upside in terms of the market really. So you basically dimension that performance, and you see less than 8 names that really produced that sort of return. Within the telecom sector, oil and gas especially was quite strong last year. Obviously on the back of the sort of movement that we saw in crude oil prices. This year I don't expect it to be significantly different. Again, our market is really far removed from what goes on globally, and that's really down to the fact that you've got very little, near no, foreign participation in our markets today, and the pool, from the global economy is really very limited and pretty much muted really on our market. So participants essentially will focus on companies with really good dividend yields, strong earnings, and that has been the play for quite some time, and we're likely to even see that play out over the next couple of weeks as we start to see year-end earnings, particularly for the banks, start to roll out. For companies that have got really decent dividend yields north of 10, we're certainly going to see some money flow into that, local money as well, and that will really remain the play. It's been a market where corporate actions have really dictated a lot of things. So as we see those quarterly results, announcements, share buybacks, and all of that, it will certainly put some upward pressure on the prices of the entities that are concerned, with those corporate actions, and I think that would be the play, for the market this year, really.